Are short out-of-the-money put options risky? Traders often debate whether short out-of-the-money or at-the-money puts are riskier. The argument for out-of-the-money put options being riskier is that their speeds, or D gamma over D spot, are higher than the at-the-money's ones, thus the gamma, which is negative, can increase, in absolute value, substantially during a market downturn. In this post, we will quantify and compare the risks of short out-of-the-money and at-the-money put options. We do so by performing Monte Carlo simulations and calculating the value at risk, VAR at 95% confidence interval, and variance of the return distribution. This strategy involves shorting unhedged puts. The return is determined as follows. Red equals P_T0 P_T, MK. Where part 0 and PT denote the put prices at time 0 and expiration respectively. K is the strike price, K equals 90, 100 for out-of-the-money and at-the-money options, respectively. M is a factor for margin. M equals 100% means that we sell a cash-secured put. Note that the above equation takes into account the margin requirement in an approximate way. The exact formula for margin calculation depends on brokers, exchanges and countries. But we believe that using a more realistic margin calculation formula will not change the conclusion of this article. We use the same simulation methodology and parameters as in the previous post. The parameters are shown in a table on our website. It's important to note that we focus here on the risks only. Hence we utilize the same values for the options implied volatility and the underlying's realized volatility. In real life the put's implied volatilities are usually higher than the realized due to volatility and skew risk premia. This means that the strategy's real-life expected return is normally higher. Our simulated return is more conservative. A table on our website summarizes the risk characteristics of short put options. We observe that for the same level of leverage, short out-of-the-money put positions are actually less risky than the at-the-money ones. For example, for M equals 100%, i.e. a cash-secured short put position, the variance and VAR of the out-of-the-money position are 0.0031 and 0.1303 respectively. They are smaller than the at-the-money options counterparts which are 0.0075 and 0.1940, respectively. The risk comes from leverage. Let's say, for example, a trader wants to sell out-of-the-money puts. Since he receives less premium for each put sold, he will likely increase the position size. For example, if he sells 2 out-of-the-money puts using leverage, M equals 50%, then the variance and VAR of his position are 0.0133 and 0.2783 respectively. Compared to selling one at-the-money cash-secured put, the risks increased substantially. VAR went from 0.194 to 0.2783. In summary, ceteris paribus, a short out-of-the-money put option position is less risky than the at-the-money one. The danger arises when traders use excessive leverage.